Welcome to the Deep Dive, where we take that mountain of investment research you're looking at and boil it down into actionable knowledge. Today, we're getting into the guts of modern industry. Rockwell Automation, that's ticker ROK.
Right. And ROK is fascinating because it sits right at this nexus of huge trends. You've got AI, digital transformation,
Yeah.
and this massive push for reshoring, bringing manufacturing back home. On paper, they look perfectly positioned.
Exactly, they really do.
But, the analysis we dug into throws up a really big question for investors, maybe even a bit of a chilling one. Is Rockwell the essential backbone for this next industrial revolution? Or is the stock, frankly, just priced for perfection?
Leaving no room for error.
Precisely.
Yeah.
And when this analysis wrapped up, September 27th, 2025, the share price was sitting at $343.58.
Yeah, and that price point is key, because what jumped out immediately from the quantitative work was this pretty significant gap, a gap between that market price and, well, what the fundamentals seem to suggest its value is.
So we definitely need to talk about Rockwell's strengths. I mean, it's a quality business, durable moat, all that. But we also have to look hard at the valuation risks baked into that $343 number.
So the fundamentals maybe don't support the current price.
Well, our estimates suggest the market's already pricing in this massive, flawless recovery, a recovery that honestly looks pretty vulnerable to some big economic headwinds we're seeing right now.
Got it. So how are we going to tackle this?
Okay, structure-wise, we'll start with the foundations, chapters 1 to 3, the business itself, the management team, and the financials. Get a feel for the quality.
Right.
Then in the second half, we'll zoom out, look at market context, risks, and some pretty surprising insider selling activity we found.
All right. Sounds like a plan. Let's get started then. Let's open up the engine room. Chapter 1, the engine room. A deep dive into Rockwell's business.
Okay.
So to really get Rockwell, you can't just think hardware. They're selling this whole integrated automation ecosystem. It's designed to create this flywheel effect, make customers sticky.
That ecosystem model is really the core idea. It's brilliant, actually.
And they break it down into 3 main parts, right?
Yeah, 3 segments. The foundation is what they call intelligent devices. That's
Okay.
the physical stuff. Your controllers, your drives.
The hardware?
Exactly. Heavy-duty hardware. Mostly under that super trusted Allen Bradley brand name. That's the installed base. That's how they lock customers in.
Okay, so hardware first, then what?
Then you move up to the brains of the operation, software and control. Think of it as the central nervous system. The big piece here is their factory talkie software suite.
Factory talkie. Okay.
Yeah, that handles visualization, analytics, and really importantly for investors, it drives that annual recurring revenue, ARR. Gives them margin stability.
Recurring revenue, always good to see.
Always. And then the third piece completes the circle. It's the human element, Lifecycle Services.
Yeah.
They brand it as Lifecycle IQ Services.
Lifecycle IQ.
Right. This is your maintenance, consulting, training, system design. Basically, making sure the customer gets the most value out of the system over its entire life and capturing revenue along the way.
So it's a complete package, hardware, software, service.
Pretty much. Designed to keep you in their world.
And the world they operate in. It's booming, isn't it? They call themselves the world's largest company dedicated to industrial automation and digital transformation.
Well, they are the largest pure play. And yeah, the market tailwinds are just phenomenal. We're talking multi-year trends.
Like what specifically?
The whole global industrial automation market. It's projected to grow at a compound annual growth rate, CAGR, of something like 9% to 10% through 2029. That's huge.
Wow. What's driving that?
It's a few big things.
Yeah.
Industry 4.0, smart connected factories, general digital transformation as companies try to get more efficient, cut costs.
Makes sense.
And then there's the massive shift towards reshoring. We're seeing this surge in brand new factory projects, greenfield projects popping up in North America and Europe. And guess what those new factories need?
Rockwell's ecosystem.
Bingo. The whole integrated package.
But, okay, they're the biggest pure play, but they're not the only players, right? It's an oligopoly.
Oh, absolutely.
Yeah.
It's dominated by giants. Their main rivals are these huge industrial conglomerates like Siemens and Schneider Electric.
And those guys are bigger overall?
Significantly bigger, yeah.
Huh.
More diversified, too. They have deeper pockets, and sometimes they can bundle automation with, say, energy solutions or building technologies in a way. Rockwell, being more focused, can't.
So if the competition is bigger, how does Rockwell hold its ground so well? What's their edge, the moat?
The moat is all about switching costs. They are incredibly high, extremely high.
Explain that a bit.
Look, once a big factory is designed and built around the Rockwell Allen Bradley system, everything relies on it. The processes, the safety systems, the worker training,
Yeah.
everything's integrated.
Oh.
So trying to rip that out and switch to, say, Siemens, it's not like swapping out a computer mouse. It's a massive, multi-million-dollar undertaking.
Yeah.
You risk production downtime. You have to retrain everyone. It's just prohibitively expensive and risky for most companies.
So they're locked in.
Pretty much. The proprietary tech, the capital already sunk. It creates this incredibly sticky customer base. Very hard for competitors to break in once Rockwell's established.
That sounds like a powerful advantage. Okay, so sticky customers, strong market position, but that only works if management knows what they're doing, right? How they deplete capital.
Exactly. Let's shift from this factory floor to the C-suite.
All right, Chapter 2, Management Evaluation.
First thing to note is stability. The CEO, Blake Morai, he's been in charge since 2016, chairman since 2018. That's a good long tenure.
Provides consistency.
It does. And we've seen management make a clear shift recently. They're prioritizing integration, making all the pieces work better together, and focusing on profitability. They even put the brakes on big acquisitions after buying companies like ClearPath Robotics.
Okay, focusing inward for a bit, how does that play out in capital allocation?
Well, there are two main directions right now. First, this big, ambitious reinvestment plan.
Tell me about that.
They've committed over $2 billion over the next 5 years. It's going into upgrading plants, beefing up digital infrastructure, hiring talent mostly in the U.S. A stated goal: boost efficiency, expand margins.
$2 billion. That's a significant bet.
It's huge.
Yeah.
And then the second path is shareholder returns, which they're very consistent about.
A dividend?
Yeah, the dividend track record is solid, something like 15 to 16 straight years of dividend growth. Right now, the yield's around 1.5%, works out to $5.24 per share annually.
Yeah.
It signals confidence, you know.
Okay, stable leadership, big investment plan, reliable dividend.
Yeah.
That's pretty good. But
Yeah.
here's where the analysis introduced some, let's say, critical tension: efficiency.
Yes, the ROIC.
Right. Return on invested capital. The trailing 12-month figure is 13.93%, which on its own sounds okay, maybe.
It sounds respectable in isolation.
But the trend is the issue. It's falling steadily for years. It peaked back in fiscal 2019 at 23.19%, fell to 12.39% in the 2024 calculation they used.
And that declining ROIC, that's the big red flag for me in the analysis. It basically means that for the last few years, every dollar management put back into the business generated less profit than the dollar before it, diminishing returns.
Not what you want to see.
Definitely not. So this new $2 billion investment plan, it's not just about growth. It's a crucial test. Management absolutely have to turn that ROIC trend around. If they don't, that high stock valuation we talked about, it starts looking really, really shaky.
Okay, that's a critical point. Sticky product, but maybe slipping execution efficiency. Let's dig into the numbers then, see what the financials tell us.
Yeah.
Chapter 3, Financial Analysis.
All right.
So big picture, Rockwell's market cap is around $38.7 billion, trailing 12-month revenue, $8.06 billion. But reflecting that industrial cycle, the immediate thing you notice is revenue declined 8.31% year over year in those TTM figures.
Yeah, that follows a couple of really strong years post-pandemic. So some normalization, maybe, but still a decline.
How's the overall financial health, though? Balance sheet.
Actually pretty solid there. They've actively paid down debt. The debt-to-equity ratio is down to a quite manageable 0.72, much better than it was 5 years ago when it was over 2.0.
That's good progress. And the dividend payout.
It's running around 61% of their trailing earnings. That seems sustainable for now. But like you said, with the cyclical nature, future dividend increases really depend on getting earnings growing again.
Okay, financials are decent, some cyclical slowdown, but now we hit the elephant in the room, the thing that brings us back to that core question, valuation.
Yep.
That trailing 12-month price-to-earnings ratio, PE, is approximately 40.5x.
40.5. Let that sink in. 40.5 times earnings. This is where the narrative really pivots from, great company to, whoa, expensive stock.
Put that 40.5x in context for us.
Okay, context is crucial. First, historically for Rockwell, it's way, way higher than its own 10-year average PE, which is more like 27x.
So much more expensive than usual for ROK itself.
Much more. And then compare it to those big competitors we mentioned.
Siemens and Schneider.
Right. And others like Emerson Electric. Siemens trades around 22.6x earnings. Emerson is around 28.1x.
So Rockwell is trading at a massive premium to its direct, larger competitors.
A huge premium, paying 40.5 times earnings. It suggests the market isn't just pricing in a recovery, it's pricing in like Flawless execution, massive growth acceleration, stuff that just hasn't happened yet.
Which brings us back to your intrinsic value calculation.
Exactly. Using a pretty standard conservative discounted cash flow model based on consensus analyst estimates, the intrinsic value range came out somewhere between $280 and $315 per share.
Okay, let's repeat that. DCF range, $280 to $315. Current price, $343.58.
That's the core quantitative finding. The stock price is significantly above that estimated fundamental value range. The market seems to be offering zero margin of safety, especially given that challenge of turning the ROIC around.
Wow. Okay. That really sets the stage for the second part of this deep dive. Let's see what the market sentiment actually is around this premium price. Chapter 4, Market Sentiment.
All right.
So, Wall Street analysts, generally the consensus rating is a buy, which sounds positive on the surface.
It does sound good initially.
But then you look at the average 12-month price target. It's only about $352.
Right. So analysts like the company. They rate it a buy. But their own target suggests only, what, 2-3% upside from the current price of $343?
Exactly. It's like they're saying, great company, but it's already priced about right, maybe even a little rich.
Yeah, fully priced for perfection seems to be the implicit message there, even with a buy rating.
What about other market indicators? Short interest.
Short interest is pretty low, 1.98%. That tells you there aren't many aggressive bears out there betting heavily against the stock collapsing.
Okay. And technically, moving averages.
Bit of mixed picture there. The stock was trading just below its 50-day moving average when the analysis was done. That suggests maybe some loss of short-term momentum, but it was still comfortably above its 200-day moving average. So the longer-term uptrend was still technically intact. Short-term dip, long-term okay.
Okay, so Wall Street sees quality but limited upside. Not many bears. Let's move on to who actually holds the shares, because this is where the story gets really conflicting. Chapter 5. Ownership structure.
Yep, this part is quite revealing.
So institutional ownership.
Very high, as you'd expect for a big blue-chip industrial like Rockwell. Around 86%. Your usual suspects are the top holders, Vanguard, BlackRock, the big index funds and institutions.
Standard stuff for a company this size. But the insiders, the people running the company, that's where the signal seems to contradict everything else.
It really does. First off, overall insider ownership is tiny, just 0.2%.
Okay, not unusual for a large cap, maybe.
Perhaps not on its own. But then you look at the transactions. What have insiders been doing with their shares over the past 12 months?
Let me guess.
Well, the numbers are stark. There were 83 sell transactions by insiders versus only 11 buy transactions.
83 sells versus 11 buys.
Yep. And we're talking significant sales, including major disposals by the CEO, Blake Moret himself, and other senior leaders.
Wow. Okay. So the people who presumably know the business best, who see the orders, the pipeline, the challenges, they are consistently selling their shares at these high price levels.
That's exactly what the data shows. They're heading for the exits, essentially.
How do you square that? Wall Street says buy, but the insiders are selling heavily.
It's very hard to square nicely.
Right.
I mean, the insider selling pattern strongly reinforces those valuation concerns. We talked about the 40x PE, the price being above the DCF value. It suggests the insiders themselves might think the current price is a great opportunity to sell, not necessarily to buy.
That aligns perfectly with the valuation concerns. Okay, let's look at the potential storms on the horizon, the external factors that could make that high price even riskier. Chapter 6, Risk Assessment.
Right, the potential pitfalls.
So, summarizing the internal weaknesses we've discussed, you've got the stretched PE ratio near 40, you've got slowing organic growth recently, and crucially, that declining return on invested capital trend.
Those are the key internal watches.
And the opportunities are clear too. Keep growing that high-margin software business, the recurring revenue, and ride those big waves Industry 4.0 reshoring.
Absolutely. The potential is there.
But the threats, particularly the macroeconomic ones,
No.
they seem pretty serious right now.
You really do. And they both circle back to making big investments more expensive or uncertain for Rockwell's customers.
First one being interest rates.
Exactly. Interest rates. When rates are high, like they have been, it just costs companies a lot more to borrow money for big projects. Building a new factory, a major automation overhaul. These are huge capital expenditures.
So they hold off.
They get cautious, they delay projects, maybe cancel some. It creates this wait-and-see attitude across the industrial sector, which directly dampens demand for Rockwell systems.
Okay, high rates causing delays. And now there's another big cloud, a more recent one.
Yeah, geopolitical factors.
Mm.
Specifically, the analysis pointed to the broad new U.S. tariffs that were imposed in 2025.
Ah, tariffs. Always messy.
Always inject massive uncertainty.
Yeah.
Just when businesses might have been getting comfortable with rate levels, thinking about investing again, boom, new tariffs hit. Nobody knows how supply chains will react, what costs will do.
So it doubles down on the caution.
Precisely. It compounds the interest rate problem. Businesses just clam up again, put plans on hold, and that directly threatens the industrial automation recovery that everyone's kind of hoping for in 2025. It could really derail things.
Okay, so a high valuation facing slowing growth internally, declining efficiency, and these significant external headwinds from rates and tariffs. Let's try and tie all these threads together now. Chapter 7. Conclusion.
Okay, let's synthesize.
The bull case for Rockwell. What is it, fundamentally?
Look, the bull case is strong on quality. Undisputed market leader in their niche. A really durable economic moat built on those sky-high switching costs. They're riding powerful long-term secular tailwinds, and they have that great dividend growth track record. It's a quality asset.
Hard to argue with the quality of the business itself, but the bear case.
The bear case is almost entirely about the price you have to pay for that quality right now. That valuation is just very, very stretched. PE near 40. Way above its history, way above its peers.
And that premium exists despite challenges.
Exactly. It exists despite those serious macro headwinds, the rates, the tariffs. It exists despite the internal issue of that declining ROIC. And maybe most tellingly, it exists despite the clear pattern of insiders selling their own stock.
So let's hammer home that core quantitative finding again.
The current share price, $343.58 when analyzed, is trading significantly above the estimated fundamental intrinsic value range, which the DCF model put between $280 and $350 per share.
Quite a gap.
A significant gap. So the concluding outlook is this. Rockwell is, without doubt, a high-quality company dominating its space. No question. But the current stock price seems to have already priced in not just a recovery, but a perfect, robust, flawless future.
Leaving no room for error.
Precisely. For an investor focused on value, looking for some margin of safety, this current price offers very little, especially if those macro headwinds stick around, or if that big $2 billion investment plan doesn't succeed in reversing the ROIC decline.
So that really crystallizes the dilemma for you, the listener. You have a top-tier business trading near what analysts think it's worth in a year, but significantly above what a fundamental valuation suggests right now. Do you prioritize owning that quality regardless of the elevated price and the risks? Or do you demand that margin of safety, especially when you see efficiency slipping and insiders heading for the door? That's the key question this analysis leaves us with. This deep dive analysis was provided by Stock Analytics AI. If you want more insights like this, especially priority access to deep dives on specific tickers, definitely like and subscribe to Stock Analytics AI.
Yeah, members who sign up for €499 a month get exclusive priority access. We're actually aiming to cover all the S&P 500 stocks over the next few months, so members get first look.
And if you just want a one-off deep dive on a stock you're interested in, you can always drop them a super thanks.
And finally, the necessary disclaimer. This analysis was generated by an AI system.
Oh.
It's purely for educational and informational purposes. It should absolutely not be considered financial advice.
Please always do your own research, consider your own circumstances, and maybe consult with a qualified financial advisor before making any investment decisions.